Chris Bullock. I'm with Cross Country Mortgage. Um, Here in the beginning, I usually like to kind of start with talking about my website a little bit. So it's CCM Bullock. That's my last name, BULLOCK.com. If you go to that website, there's a bunch of tools, different articles, things you could share on social media, a lot of different assets that are useful. I don't have that queued up here, and I'm not going to rearrange the screen share to do it, but I'll put the link in the chat after this is over if you want to check out my webpage. Today, we're kind of doing Mortgage 101, so very simple kind of general introduction. Specifically, this is tailored for real estate agents, so you know a bit more about the mortgage side, maybe a little easier to field questions if a buyer maybe read something online or talked to a friend and they're kind of hitting you with mortgage related questions. Click here and there we go. There's my contact information. Do you want to take a screenshot of that? Or like I said, I'll put my website at the end. Today, we're going to talk about thinking like a leader, the CCM difference, cover some mortgage terms, a bit more about cross-country mortgage, and then let's grow together. So first thing, thinking like a lender. So for us, it's a numbers game, right? Everything we think about is related to finding a way to get your buyers qualified to purchase a home. And whenever we're, right off the bat, trying to analyze whether or not someone's going to qualify, we're looking at really this handful of items here. Over the phone, I can ask someone about these items, and I'm going to quickly figure out if they're going to qualify or if we need to do a little bit of work. So one of the first things we ask is credit. What's your credit? Do you know what your credit score is? Do you have credit? You'd be surprised. There are a lot of people out there who they don't want to get a credit card because they're worried they're going to miss a payment and it's going to ruin their score. At the same time, if you don't have any credit, you can't qualify for a mortgage. So if you see someone out there who needs some credit advice, I'm no credit expert. That's what I warn all my clients. The expertise I have is I pull about 400 credit reports a year. So I see a lot of people's credit. I have a really good idea of what makes a good credit score, what can hurt a credit score, how to improve a credit score. So I'm not licensed to be a credit repair person, but I can certainly give someone some good free advice, and that's what I like to tell them. Advice you get from me is free. If you go to a credit repair specialist, many of them are going to charge you $200, $300, $400 a month for their services. So one of the first things we look at is credit. Credit is going to determine what programs you qualify for. Are there any first-time homebuyer programs? Are there any grants? What's available to you? Generally speaking, if you're asking someone about their credit and they say, I've got between a 580 and a 620, I'd say that's borderline. That's all right. We might be able to make that work. Below 580, we've got to do some work before we're going to get you qualified. 650 or higher, now we're talking about possible grant programs. 700 or higher, slam dunk. Get them to sign a buyer's agreement right away because that's an excellent credit score. Monthly survival number. So think about that as a budget. A lot of people, whenever we do, I know I'm skipping to the end here, but a debt to income analysis, it's going to be a much higher number than what they realistically can take on given their utility bills or their childcare expenses and things like that. So we like to talk about, hey, what's the number that you feel comfortable with? Maybe we tie it to what are you paying in rent right now? Could you take on, a $2,000 payment? Is that something realistic for you? So a big part of what I like to do is do two analyses. What's your absolute max budget and what's that monthly payment? Can you stomach that? A lot of people go, I don't want to be anywhere close to that. Okay, well, what's the comfortable number? You tell me what you're comfortable with per month, and then I'm actually going to work backwards and say, well, in the areas you're shopping, the monthly payment you have in mind is going to get you a budget of about this much. And maybe they started with, I want to buy a $250,000 house, and I might have to tell them, well, that's more like a 200 or a 225 house to be able to stay within your monthly budget. A lot of the times, the nice thing about doing that is they wind up somewhere in the middle. They go, okay, well, I can stretch it a little bit to get closer to what I want, but I know I don't want to be that high. So the next item we ask about cash or more generally assets, because not only are funds you have in checking or savings usable in many cases, usually with conventional lending. If you've got a bunch of money in your 401k, that will qualify you all by itself, and you might not even need to liquidate any of those funds to qualify. So when we're talking about assets, usually what I'm talking about is, do you have some funds for a down payment? Now, down payments are going to be specific to the loan program you're looking for. There are down payment assistance programs, so there's some where you might not need to come up with a down payment at all. That being said, for the most part, I'm telling people you need between 3 and 5% for a down payment. You need about 2% for closing costs. Now, over the last 2-3 years, closing costs have gotten very expensive. Prepaid interest has gone up because interest rates are up. That number might be closer to 2.5% these days. But generally speaking, if someone's going to need 3 to 5% for a down payment, 2 to 2.5% for closing costs, for a total number of 5 to 8%. Income, that's a fairly obvious one. We want to make sure that someone has a 2-year work history. Do you have any other kind of strange forms of income? Are you, myself, I'm entirely commissioned, even though I'm a W-2 employee. For me to qualify for a home, I would have to do 2 years average over my commissions the last couple of years. If someone's self-employed, depending on how long they've been self-employed, we'll need to look at their tax returns. Real estate agents, 1099 income. We look at a 2-year average based off of your tax returns. If you've been in business for less than 5 years, if you've been in business for more than 5 years, we just go with the most recent year. So big part of that income calculation is pretty obvious, because that is one of the 2 big things in the debt to income ratio. A debt to income ratio is a calculation to come up with how much you can afford in a new payment based off of the debts you currently carry and your gross income. So a lot of people don't realize this, but the way that we calculate your income is actually based off of your gross income. So before 401k contributions, before your health insurance is paid, before anything is withdrawn or deducted from your income. So the top line number. So if someone makes $20 an hour at 40 hours a week, I'm going to multiply those together, do a monthly average, and that's what I'm going to use for their income. Now, the debt to income ratio, obviously debts is the other big part of this calculation. We look at the debts that show up on someone's credit report. So your cell phone, your cable bill, those don't count. The only thing we're looking at are liabilities you have. So open credit lines, your car payment, your student loans, personal loans, and credit cards. Just generally speaking, for a debt to income ratio, we're looking at about 50% of someone's whole gross income can go towards all debts. So all the debts that they already have plus the new mortgage. So I won't get into the math too much about that. We are kind of planning some classes that are more, client focused, where we might do something to have people come in, have worksheets for them, and we'll basically say, okay, let's do the math together. You do your own math, and I'm going to do some sample math at the top. And then we kind of work through these numbers so that they can see, okay, this is how it's calculated. This is how much I can afford. So any questions there? All right, cool.
But you're saying total debt 50%?
Yes.
Total debt.
Yeah. That
house.
the house and the all the other liabilities. So what makes up a credit score? This is interesting because a lot of people think that the credit scores are calculated kind of arbitrarily. Now, the reason they're a little bit different is every bureau, so there's TransUnion, Experian, and Equifax, they all have a slightly different way of calculating it. And a lot of people don't realize this either. They actually change the calculation depending on the risk model of the debt. So they will change the calculation to be harsher if you're applying for a mortgage versus, say, a credit card, because a mortgage is a much riskier loan in the event of a default than, say, $1,000 credit card. So if you're talking about a two, that since I've been in this side of the business, they've been doing it. Yep. Yeah. So a lot of people, they'll say, well, my Experian app says I have a 650, and then I pull their credit report and it could be 20 or 30 points lower than that. At the same time, the way that it's weighted is more heavily on your payment history and your derogatory credit. So if someone has no derogatory credit, no missed payments, their scores for the credit card and the mortgage are going to be probably pretty much the same. So this just kind of breaks it down. So 10% of the consideration is towards new credit. So how recently do you have accounts open? That's weighed a little bit as well with the types of credit, and think of those two working almost in conjunction. If you have a brand new mortgage and you go to apply for another mortgage, it might have a harsher effect than if you just opened a new card. Length of credit history. So pretty obvious there, how long you've had these accounts, how long they've been in good standing. That's the toughest thing when it comes to credit repair. A lot of the times, I just have to tell someone your score is going to go up over time the longer you have them in good standing, but you just haven't had credit for that long. So you're not, showing the highest possible score. Amounts owed, that's a big factor. Just generally speaking, if someone's talking about paying off or paying down their credit cards, the sweet spot is 25% balance to limit. So you don't necessarily want to go all the way to zero, because then you're not showing any open credit lines. So you don't want to pay the card off necessarily entirely. At the same time, you don't want to have more than 25% of the balance to the limit. If you keep it at 25, that's kind of the sweet spot, and that plays 30% of the role, so about a third. And then payment history, obviously that's a really big deal, making sure you don't have that many late payments. Compounding late payments play a big role. The killers are collections, charge-offs, and then the obvious, foreclosures or bankruptcies really, really just destroy someone's credit. So, any questions there? Cool. A little more breakdown on scores. I kind of covered this a little bit already. 740, excellent. 680 to 739. That's very good. I think the national average I looked at the other day was about 675, 680. So just as an example, like our branch average, which I want to say we do about 400 or 500 loans a year, that is somewhere around 725, 730. Here comes the rain. 1 in 5 Americans find errors on their credit report. This is a very interesting thing for me because I think a lot of loan officers, what they'll do is they'll pull the credit report, they look at the scores, and then they go, okay, here's what I'm seeing. That's it. I do a little bit more of a deeper dive on it. And then just, like I said, I try and help people with some free analysis of what I'm seeing. And one of the things that I run into the most is, hey, you have a $75 medical collection to so-and-so dentistry. Did you know that this existed? No, I had no idea, because they didn't stop at the desk on the way out to pay the copay, and maybe they got a couple of phone calls, came up as spam, they ignored it, maybe something came in the mail, it looked like junk, they threw it away. Next thing you know, it's taken to collections, and they're just now finding out about it. And if they were to pay it off, maybe they see a jump of 20 or 30 points on their credit score. So one thing to look at, and what I recommend, it's great to do for yourself or to do or to recommend to your clients, is go to a website called annualcreditreport.com. Once, I believe maybe twice a year, they'll let you pull your credit report for free. It doesn't give you your scores, but it shows you all your open accounts, even the ones in collections. So you can take a look and see if there's any open medical collections or anything like that. .com. Yeah. So most, I would say, credit repair people use that website. When you sign up for a credit repair, basically what they're going to do, one of the first things they're going to do is they're going to hop on there with your info, pull your credit report, and then they're going to start calling these companies that have these open collections, and they're going to be settling these debts. And a lot of people don't realize this, but you don't necessarily need to pay the full amount. You can negotiate to pay a portion down. Ideally, what they'd be doing is they'd be charging it off, not selling the rest of the debt down to another collection company. But if you're savvy enough, you call and you commit to it and you badger them, honestly, you can kind of negotiate your way to paying less than what the actual balance was when it went into collections. Another thing that a lot of people don't realize is medical collections can be removed from your credit report. So that $75 dental collection that I was just using as an example, you call them up, you pay the $75, and you say, please report to Experian or Equifax or whoever that this was paid in full and I would like this removed from my report. It can take 30 to 60 days, but that actual collection history will go away like it never happened, and you can see a huge boost in your score. I mean, I had a guy, we did this like kind of just a, call it credit repair, but more like, hey, here's these items I think you need to address, do this, this, and this. He did it. 60 days later, we had a 50-point jump in his score, and they ended up buying a house the next month. So monthly survival number. So this is a good chart. This is kind of what I was talking about that we would hand out and kind of let people do their own numbers. But just as a good example, you can see spam call. You can kind of see what we're taking into consideration with all of this, any other things, even contributions to your retirement funds. And then, a big factor, and you might hear this from a financial advisor, is how many months of survival funds, how many months of rainy day funds do you have? Generally speaking, for someone that's on a salary or full-time hourly, we recommend you have about 4 to 6 months in emergency funds. For someone that has more fluctual income like ourselves who work on commission, we usually stay closer to 8 to 12 months in emergency funds. Cash, this is just a really good chart on some breakdown for the minimum down payment loan amount. So you can see conventional first-time home buyers can do 3% down. Repeat buyers can do a minimum of 5% down. Excuse me. Government loans, 0% for VA and USDA, 3.5% for FHA. And then jumbo, not that we run into that market all that much. If you do, call me, please. Huge loan amount. I'm just kidding. It's 10%. Maximum loan amounts. So 726. I have to double check. I think that's the current number. For conventional, FHA, VA, USDA, those vary a little bit. I want to say FHA is, we don't run into it that much, so that's why I don't know it. So isn't it like 450, something like that? Which is crazy because I only think like 5 years ago it was, yeah. Jumbo, the max is 5 million. Like I said, if you run into one of those, congrats.
Yeah.
Gift funds, conventional, government, and jumbo, you can receive gift funds on your primary residence. Your gift donor has to be a relative of yours. Conventional is a little easier with that requirement, and they'll allow someone like with a close relationship to you. So if you had like a pastor at your church, yeah, maybe I would submit it and we'd see what underwriting would say. I had a close personal friend once. Yeah. I had a close personal friend. That one went through underwriting because we had the ability to document that they had a history of being friends. Yeah. But yes, they can donate or gift you the funds. While calculating the down payment, clients should remember to include closing costs. They can add up to thousands of dollars, typically 2 to 5% of the purchase price of the home. That's kind of what I was talking about earlier. A lot of people think, okay, well, I've got the down payment saved, and then we run into an issue of, well, you're going to need another $5,000 or $6,000 for closing costs. Typically, though, what I'd recommend, it's tough with the market the way it is right now, and the fact that it is such a seller's market. Typically, what we would recommend if someone needs extra funds for closing costs would be to negotiate it into the contract by offering over the asking price and asking the seller to kick back funds. So the example I like to do is, let's take a house that's $200,000. The closing costs are an estimated $6,000. Well, if you offer $206 and ask the seller to kick back $6,000 in closing costs, that takes care of the closing costs. The buyer just needs to come up with, say, $6,000 for a down payment, so that's 3%. The seller nets out the same at the end of the day, so they shouldn't really care. But the buyer doesn't have to come up with an extra $6,000 that they might not have saved. The caveat to all of that is the home must appraise at the higher price. So it's going to have to appraise at 206. If it only appraises at 200, then we're back to, square one. We're going to have to figure it out. So closing expenses, something to consider. I think a lot of people, I know I do this myself sometimes, where I'm only thinking about lending related fees, title fees, and the direct closing costs that show up on a closing disclosure. But there's also a few other things to consider: the home inspection, which is paid out of pocket up front, the appraisal, which is paid out of pocket up front. A lot of people don't know this. Just to note, the appraisal can be paid by credit card up front. So if someone wants to put it on a credit card, they can. Homeowners insurance, most people, I'm saying, just put it in the escrow and make it a part of your normal closing costs. That way you don't have to pay on it in the future out of pocket. Attorney fees, it doesn't really apply all that much. Lender title, tax, and interest, those are the ones that make up the bulk of the fees whenever I'm estimating fees for somebody. Income, talked about this a little bit, but we look at a history of income. Changing jobs, obviously not something we'd recommend. Depending on their loan program, we can get around job gaps. It really depends on a definition of what led to the job gap. But conventional loans, for whatever reason, if someone's salary, but they were out of work for 4 months last year, there's a really good chance that I can just say, well, she took some time off to be with her kids. It could be something as vague as that, and they will be okay with it. It really depends on how they're working currently. So can't be part-time, would have to be full-time, would have to be in a salary situation. But sometimes we can get around that stuff. It used to be, a couple of years ago, that everybody had some kind of weird job gap or change in work because of COVID, and there were some extra leniencies to that. They've recently kind of gotten rid of those, more or less.
So if one partner is full-time,
you can, but you have to have a 2-year history of working as a part-time employee, and we do a 2-year average. Yep. Debt to income, that's what I was talking about earlier. It says 43% or less. This is the 50% number that I was talking about earlier. With good credit, conventional will let you go all the way up to 50%. With good credit, FHA and VA will let you go all the way up to 56%. So you can really push the budget on those. Most people, I'm saying, usually, like when I'm pre-qualifying somebody and we're just working off some rough numbers, I try and put it around 45 and tell them they've got wiggle room, because you never know what you're going to find. They could be shopping in Solon, and then all of a sudden they wind up looking in Shaker Heights and the taxes are double. And now that's eating up all of the extra room we had in our budget. So.
What's the cost of housing? I like to use it a lot. 'Cause I have some people that are, this is my dollar amount. I'm like, okay, if we go $5,000, your loan's only gonna increase.
Like a monthly payment wise?
Yeah.
I would have to do the math on it though. I want to say probably closer to $20, I would say. Yeah. I'll have to check, yeah. Yeah, let me do some quick math here.
I'm like, dude, you can go up 1,000
Mm-hmm.
and your payments have to go up.
And if we're talking about purely just the mortgage itself, not taxes or insurance, right? So at 7%, it's only about $7. Yeah. I think in my head, I was thinking, well, when you go up in price, your taxes are going to go up too.
Yeah.
But if you're looking at the exact same property, just offering more, yeah.
$35 a month.
Right. Yep.
And it's like, yeah,
And that's,
it's like this checks all your boxes.
right.
If this house doesn't, you have to do this, and it's like $35 more a month.
Mm-hmm.
And 12 months.
Yeah, buyers, and I'm sure everybody's feeling this right now, are extremely price sensitive about everything. I mean, everything. I had a guy the other day who he sounded on the verge of tears when I talked to him. Oh, sorry. And I was like, what's going on? How are you? He's like, it's just overwhelming. He filled out 14 different pre-approval applications with 14 different lenders to shop them all against each other. And I wanted to be nice, but I also wanted to be honest and be like, if you're beating yourself up this much trying to do all this, I mean, what's the most you're gonna save? A few bucks, like compare 3 or 4 maybe. That I don't.
This guy qualifies for $300.
Oh, really?
So we found this beautiful property. He wanted an outbuilding.
Mm-hmm.
This outbuilding is unbelievable. Unbelievable. 2-story, holds 8 to 10 car garage. It's only $15,000 more than properties without an outbuilding.
Yeah. And what'd you pay $15,000
I
for?
was like, it's only $15,000 more for property without outbuilding. And this is magnificent. I mean, it's got crane in it, without engines, and it's incredible. A half-acre property. I just don't want to know that.
Yeah. That's tough.
So, yeah. Anyhow.
Yeah.
I'm like, only increase your
Like I said, people are very sensitive.
one of those, he's a mechanical engineer, very intelligent, but not.
Analytical. Yeah.
Which I would think that I'm like, how are you not seeing?
Yeah. Sensitive maybe too.
Yeah.
Interesting tip here, just ways to reduce the debt to income. So let's say this happens all the time where you'd be surprised, someone will be like, hey, I'm in contract. Okay, perfect. What's the purchase price? Well, it's a little higher than what we talked about. Okay. Well, when I run the numbers, or maybe they go into contract on a home, the taxes are higher and it's not going to work. Maybe we're over budget. It's not going to work in our debt to income ratio. What do I do to fix it? Well, the first thing I'm going to do is I'm going to look at their existing liabilities. It could be as easy as saying, hey, you got a credit card that's got a $200 balance, but a $50 monthly payment. I'm this close to getting you qualified. Can we mark that as paid off? Can you pay that off before closing and show us that there's no balance so I can ignore that payment? And if they do it, then we can ignore the payment and, kind of fix the problem. I've done where someone maybe with conventional, if you have 10 payments or less on an installment loan, they will allow you to ignore it. So let's say someone's got a $500 a month car payment and there's $6,000 left on the balance. Well, if they get it down to only $5,000 less, I can ignore it. So I might have them call up that place and pay $1,000, and now I can ignore a $500 a month payment, which I just did this the other day for someone, very nice lady. She's a little tight on income, driving a $500 car per month, and it was eating up a significant portion of her affordability. And I kind of told her, I was like, that $500 car, as nice as it may be, is reducing your purchasing power by like $50,000 or $60,000, which is the difference between her like buying a real rundown house and buying something nice in a nicer neighborhood. And I think it was kind of a sticker shock for her to hear how much she was kind of handicapping herself with this high car payment. But yeah, so those are kind of the tools we'll look at to try and solve these issues. Pre-qualification versus pre-approval. This is a classic misunderstanding amongst buyers. Pre-qualification is a very simple, just generally over the phone, back of the envelope is what I like to call it, where I'm just writing down, okay, well, how much do you make? And what kind of debts do you have? Any of those student loans? Just kind of getting an idea. And I go, yeah, from what you told me, I think you can afford between 350 and 400 probably, versus a pre-approval, which is I pull a credit report, I collect their documents, it actually goes through an underwriting system, and an actual pre-approval letter is issued. So some people are sensitive about these two differences. Some people don't ever want to make a commitment, so they stay in the pre-qualification neighborhood. But I'm sure, as many of you know, you have to have a pre-approval in most cases to submit an offer. So at one point or another, if they're committed and serious about purchasing a home, they're going to have to go to the pre-approval level. So 10 key steps in the loan process. If someone's saying, well, what does this look like? This is kind of my general overview of what we're going to do. We're going to confirm your income. This is done through a verification of employment. The verification of employment is really a piece of paper, that we send to the employer just to confirm that they're still employed and that they're making the amount that is on their documents. You would be surprised. I have personally run into this. I have talked to other loan officers that have run into this. There are people out there that are good at Photoshop, and they will alter documents and submit them. And then when we do the verification of employment, we discover that they were fraudulent. So it's crazy. We check for other real estate owned. So, a quick online property search, alongside their social security number, name, date of birth and everything, we can figure out if they own any other property anywhere in the US. We look for adverse credit events, bankruptcy, things like that. Sometimes we need tax returns. That's not necessarily always true. We verify the cash to close by looking at 2 months of their bank statements. Gift funds, if applicable, we need a gift letter and all of that. And then we approve the loan through an automated underwriting system. That's basically just a computer program that looks at everything we've submitted and basically makes sure that it works. It follows the guidelines. We determine how soon the loan can be fully approved. So that's a bit of a working date, obviously. Generally, what I would say these days, our average is about 3 weeks from lock to clear to close. So if you give us anywhere around 25 days, let's say, a day up front or a day or two up front for the buyer to make the final decision to lock and get the application signed and everything. And then after clear to close, maybe a day or two to schedule the closing with title and everything and get the actual signatures done. I have my personal record is 10 days start to finish. So in contract to closed in 10 days. So we can do it really fast, but generally speaking, I tell people 3 to 4 weeks. We check for any contingencies. The way I like to do it, if I issue a pre-approval letter, I'm going to, with an asterisk and highlight it in yellow at the bottom of the email, say this pre-approval is contingent on blank. So, you know, you saving up another $5,000 or confirmation of a gift from your parents. Maybe, you know, contingent on the sale of your current home or contingent on the successful closing of your home that's in contract. So things like that, just to make sure that, you know, you, the agent, know all of the strings attached to that pre-approval. And then make sure the loan meets the terms of the offer, property, taxes, insurance, HOA dues, and all of that. So that's really more once they're in contract, then I start kind of, or not necessarily. Sometimes what we'll do is say, hey, send me the address, and then I'll plug all this in to make sure it works up front. But really, obviously, once they're in contract, we want to make sure we have our I's dotted and T's crossed before we go to underwriting. So we actually have at Cross Country a program called CCM Fast Track pre-approval. So if you think of pre-qualification as being really that very loose, you know, quick back of the envelope analysis of someone's ability to purchase, pre-approval is a little more concrete. There's documents and everything there. If we take that one step further and go to the fast track, that is a full credit approval. We do the verifications of employment and everything. It can take a few days to do this because we're doing the actual process as if they were in contract, even though they're not yet. Once that's all done, we actually get a formal approval that says that, hey, the buyer's portion of this credit application is approved. The only thing we need to finalize now is the actual property's qualification. That's the appraisal. So someone could go into contract with a fast track approval like this. Maybe we need an updated pay stub or something, depending on how much time has gone by. But realistically, we could order the appraisal the next day. That comes out back in, 5 to 7 days, and then we're scheduling closing. You could close in as little as 10 days. So if you have anyone that's interested in that, I've had some buyers that are all over it just because they can put a much shorter closing date on their offer and maybe get a little more competitive. Just a handful of standard products. So if anyone, is asking about, hey, what loan programs are out there? This is going to encompass, probably 98%, 99% of all the loans that are done across the country. They're pretty obvious, but conventional, jumbo for the higher priced homes, FHA, FHA 203K, which is FHA's renovation loan program. I don't know if it's mentioned in here again, but at Cross Country, we have a conventional renovation program as well. USDA for rural homes, VA for veterans. So those are the big programs out there.
So what's rural country? Like
really here in Northeast Ohio, anything outside of Cuyahoga County. Yeah.
So like
I have
like
so I have someone pre-approved for USDA loan out in Wayne County, so just outside of Worcester.
Okay.
If you go
0% down.
If you're buying in a rural area, the Department of Agriculture will actually they guarantee the loan, meaning if you foreclose on the home, rather than the bank taking a full credit loss on that, the USDA is going to come in and basically make the bank whole.
Okay.
Yeah, same way with like FHA and VA. So it's each department is kind of taking this on.
0% down option. But you still have to pay.
I mean, technically closing costs, but the seller can kick in up to 3%.
But I mean, I'm sorry.
Oh, you're okay.
When you don't put down 20%, you have to pay.
Oh, PMI. Yeah. So USDA does have PMI, but it's low. It's really low. VA does not have PMI. There's no PMI. It's zero down, no PMI. Yep.
So if he was looking at like 2 acres somewhere in North Canton stuff, you could do 0% down and get very low PMI.
Maybe, yep. So the USDA has a website. You can go on there and you can double check if a property is going to qualify for that program. Believe it or not, it doesn't actually qualify for any farmland or anything like that. It's only for single family homes in rural areas. So we would just have to double check and make sure that the property qualifies. Cool. And then here's, I said 98 to 99%. There is a 1% of everybody else, right? So there is a whole bucket of different programs that don't fall into the regular conventional or government loan programs, but those people still need to be serviced and taken care of. So we have a whole non-QM, that's a portfolio loan department at Cross Country, where I can do loans that would not qualify for standard products, meaning they don't meet the guidelines. Those big government agencies aren't going to buy the loans. It's not going to work. So in comes these alternative programs. So doctor loans, physicians can put 0% down, no PMI. Bank statement loans, 1099 loans, great for realtors. I've done a handful of them for realtors over the years. We will look at the deposits coming into your account. We'll look at the 1099s that you're issued every year, and we can use either the deposits in your accounts or your 1099 to come up with your qualified income. That program is used to get around someone that, let's say they make $150,000 a year, but on their taxes, they write off $100,000. So on paper, it only looks like they make 50 grand a year. Well, once you divide by 12 and you can only use 50% of that to qualify for all debts, you factor in their Audi payment and all of a sudden they can't afford a home. So in comes these programs that will basically say like, hey, we get it. You're writing everything off to avoid tax liability. We know you make more than that. We can see that on your bank statements and your 1099. So let's go that route. Asset qualifier. This is for people that have got a bunch of money. So if someone's got $5 million in the bank, but they don't have a traditional income, or they write off a ton on their taxes, or they just started a new business and that business is not showing any revenue right now, we can go with this asset qualifier that's going to basically say, okay, you got $5 million. If I chop that up over, the next 10 years, as if you were, going to regularly pay yourself out of those assets you have, I can then give them a qualified income. Investor cash flow. We call it investor cash flow. Everybody else calls it DSCR. It's basically just a DSCR loan, meaning we don't even look at your income. Your income's totally blank. We only look at a rental property you're purchasing. Can the anticipated rents on that property offset the mortgage? If that's a yes, then we're good to go. Foreign national loans, those are DSCR loans for people that do not have a credit score or they do not live here in the US. You have to have at minimum access to the US. You have to be able to come here, but you don't necessarily even have to have a credit score or a social security number. So if someone, we see this a lot with maybe someone that lives in Israel who wants to purchase an investment property here. Well, it's a DSCR loan, so it doesn't matter what their income is. We're just going to look at the property based off of, hey, does the property make enough money to cover its own monthly cost? If yes, you're good to go. And then full doc. We have a full doc loan program that's basically like, it's almost exactly the same as conventional, but not as strict. So it's just less strict on the guidelines. So if you got someone that's just barely not qualifying because of some weird thing that conventional will let it go, we can do this program as an alternate. With all of these, the caveat is they are a bit more expensive, higher interest rates, going to be a bit more cost. And you're thinking, well, why, Chris? And it's because these are so much riskier of loans to take on. Someone's going to have to put a little more up front if they're going to qualify. Loan process, I'll kind of breeze through this part, but submitting the loan application, ordering the appraisal, processing and underwriting. Once the underwriting's complete, we send out a conditional approval and we say, hey, go shop for your homeowner's insurance and send me a new pay stub. Once we have all that put together along with the appraisal report, gets submitted back to the underwriter. The underwriter will approve the loan and issue CTC or clear to close. Our closer then will reach out to the settlement agent at the title company. We'll get everything finalized as far as the documents go. The title company will schedule the closing. They sign, they get the keys. So pretty simple. I'd say, most or all of this, you're not necessarily going to be all that hands-on. A lot of this stuff is very behind the scenes, and I just kind of send out an update email along the way. It's like, hey, we're through underwriting, or hey, we're approved. So few do's and don'ts, and I actually have a flyer of this that if you ever wanted to hand it out to your clients, just as some, hey, you're working with me. We are going to be purchasing your home, especially with this NAR stuff coming out where you're going to need a buyer's agency agreement. Not a bad idea to say, hey, I'm representing you. Here's my commission. You've agreed to work with me. Your end of the bargain is don't do any of this stuff that might mess up the deal along the way. Pretty obvious stuff. Don't open any new lines of credit. Don't change jobs unless it's going to be a benefit to you, right? I had a guy one time who quit his job 3 days before closing. And he's like, I thought you verified my employment already. It's like, we have to reach out to your employer at the very end to make sure you didn't quit. But he didn't know that. So yeah. Don't buy a boat. That happened to me once.
So why don't you quit if you know you have a new house?
He's like, I have enough money in the bank and I'll find a new job. Yeah. He ran out and got a new job. It delayed closing like 30 days, but we ended up closing, if you can believe it. I don't know. Yeah. I had someone buy a boat, literally. Now, the good news is they could carry that boat payment, still qualify. It was really tight, but crazy. So yeah, some of the obvious things. And then some do's are, keep track of your paperwork, make sure you're on time on your credit payments, your rent and all of that. So here's a handful. I'll kind of breeze through these of mortgage terms. Adjustable rate mortgages, we don't run into that too much anymore, but obviously that's a program where the rate adjusts over time. APR, that is your rate adjusted for all the closing costs, not necessarily all of them, but many of them. The lending fees, some of the title fees, all of that's going to get factored into your APR. So you can compare more easily multiple lenders against each other based off of their fees. Application fee, with us, we don't have it. I would say most people aren't requiring an application fee, and if a lender does, I'd say run for the hills. Appraisal, obviously that's the appraisal report on the property itself. Appraised value, that's the appraiser's opinion of value that comes back on that appraisal report. Closing, sure we all know what that is. Closing costs, obviously we covered that already. Cosigner, that's another person who is not going to have necessarily ownership of the property. They're not necessarily going to be living in the property. They are just co-signing for another individual so that that individual can qualify to purchase the home. Credit report, pretty obvious there. Debt to income ratio we covered. Down payment, it's obviously your down payment. Equity, that is the fair market value of your home minus the amount that you owe on any kind of liabilities against that property. So if you have a $200,000 home and you have a $100,000 loan, you have $100,000 of equity. Escrow, that's the third-party entity that is going to hold and manage your funds for different things. So the title company is an escrow company. They'll hold your earnest money. They'll hold all the money until all of it's divvied out. Like the loan goes to the title company. They technically are an escrow company. And then your mortgage servicer also is an escrow company and will hold on to a portion of your monthly payment to go towards future bills like taxes and insurance. Fannie Mae and Freddie Mac, those are the two big government banks that make up conventional lending. FHA, that's the big Federal Housing Administration loan program most people are aware of. FICO score, that's obviously the score that's used, the credit score that's used to qualify you. Fixed rate mortgage, rate doesn't change over time, different obviously than the beginning at an adjustable rate mortgage. LTV, that's the loan to value. So that's for lenders, that's what we're usually thinking of whenever we're talking about different loan programs. So if someone's putting 3% down, then their loan to value is 97%. Mortgage, the loan against it's the lien against the property that you're purchasing. Origination fee, that is a fee charged by a lender in exchange for the loan services. Points are fees that can be paid to get a lower interest rate. Pre-approval, talked about that. Principal, that is the amount you're paying each month that's actually going towards the equity in your home. So you're buying down the loan and adding to your equity over time. PITI, that is your total monthly payment. That includes the principal, the interest, the taxes, and the insurance. So it's a full mortgage payment. PMI, talked about that a little bit earlier, putting less than 20% down. CCM does have a specialty program within conventional lending where you can put 15% down and avoid PMI. There's a couple extra qualifications, but people love that. Whenever they qualify for it and I tell them, hey, 15 down, no MI, they're all over it. Rate lock, whenever you're in contract, we can actually submit the loan application and lock your interest rate in. So if anything happens in the market, you're protected. A refinance is to refinance. So to basically close out the mortgage you have on your home currently and replace it with a new mortgage. In some cases, it's just giving you a lower interest rate, shortening the term. In other cases, you can actually pull cash out of your equity you have in your home, go on vacation, add the addition you've been thinking of, anything like that. Underwriting, that is the entity within CrossCountry or any other lender that is going to review the credit qualifications of the loan application. They're the ones that make sure that we are following all the guidelines for the loan program that we're applying for. USDA loan, VA loan, we talked about those already. So I'm quickly running out of time, so I'm just going to kind of skim through these last few. CCM, we're headquarters. I did have a feeling this was older. We're not in Bretzel anymore. We're in downtown Cleveland. So our headquarters opened, goodness, it was a little over a year ago now, but a year and a half ago. So we're local, pretty big company. It's just announced a few days ago that we are the #1 retail lender in the country, which is pretty crazy considering the company was started by Ron Lenhard, our owner, in 2003. There were 6 employees. He grew up in Maple Heights, went to Baldwin Wallace, played football, and started this company, and it grew from 6 people all the way up to 7,600 employees and $150 million big headquarters downtown and everything. So it's a pretty remarkable story, and he's a big rah-rah Cleveland guy, as am I, Ron Lenhard. So Ron, I don't know for sure. Maybe he's mid-40s or early 50s, yeah. So fast closings, we talked about that. Tons of different loan options. We are the latest on tech. I mean, one of the big things he did as the company was coming up was he bought this this tech company so we have all this proprietary software that's just for cross country, state-of-the-art stuff. It's really cool. And then we are obviously trying to be super competitive on rates in every possible way. So if you need anything, let me know, and I appreciate you being here for this. And if you have any questions, happy to help. Give me a call. So.